Hello there. Today we will be boosting our academics in Fundamentals of Accounting 1. So without further ado, let's get started. So the general view of Fundamentals of Accounting 1 will include the following concepts. So the first one, you will be required to learn about journals. Okay. Maybe before I continue, the aspect of accounting is recording data. So these books of accounts which I will be listing, both of them will be an aspect of recording. Okay. So what does the journal do? A journal records transactions. A journal records transactions, of course, for a period of time. Okay, so journals records transactions for a period of time, and these transactions may involve multiple accounts. Okay, so after we have all our journals, we go to another book of accounts which we call ledgers. So the definitions that I'm giving are not those which you would want to write in an exam. This is just for easy understanding. So journals is all about recording transactions. What about ledgers? Remember, the moment you are creating journals, you are recording transactions which will involve numerous accounts. But in ledgers now, this is where you record, okay? You record transactions relating to a specific account. Okay? A specific account. Okay? So an example, maybe one of the transactions will be depositing cash to bank. There, it is a transaction between the cash account and the bank account. But the moment you come to record that transaction which you've already journaled here in ledgers, you'll be required to create specific accounts. So for instance, you'll be required to record or to create cash account and bank account. Okay? More of this will be explained in our later videos. So under ledgers, we have the common ledgers, but we also have a certain concept which we will do later on, and it is to do with control accounts. Control accounts, these are used by businesses which have numerous transactions and maybe, for example, numerous customers. So, it is very convenient for them to use control accounts so that they can spot an error when they are preparing all those numerous transactions. Okay, so the two main categories which are normally stated in this course, or rather this unit, for some of you, there is sales. We have sales, ledger, control account, And then we have purchases. Okay, so this one is another concept which will be explained to you. Yeah, so now after the ledgers, what next? So the moment you prepare a ledger, of which we've said it is an account for a specific item. The moment we record all the transactions involving that specific account, we will have a balance. We will either have a debit balance or a credit balance. So that balance, we will record it in a book of account, which we call trial balance. Okay? Now, take note of these two words. The aspect of balance is in two ways. Number one, we are recording, we are recording balances of the ledger accounts. Okay? So that is why this is called a trial balance. Also, it is called a trial balance because we will be recording the balances of the different ledger accounts which we have, and then we try and see if the debits and the credits balances are balancing. Okay? So that is the work of the trial balance, to record balances of ledger accounts and see whether the debit and the credit balances will have the same figure, or rather will balance. Okay? So we will see this in our later video, but now a question may come up. What if you record debit balances and credit balances and you find out that the figures are not the same? The trial balance is not balancing. So if it doesn't balance, then now is one concept which we will also learn, and it is called suspense. You create a suspense account. So when a trial balance doesn't balance, you will create a suspense account, and the moment you will create a suspense account, the trial balance will balance. But now, in a trial balance, there shouldn't be an account which is called suspense account. So what you will be required to do is you will be required to spot the error, and that error will offset this amount in the suspense account, whereby now the suspense account will be having a zero balance. Okay? So the main objective when the trial balance doesn't balance, number one, you create a suspense account, and then number two, you look for the faults which resulted to the trial balance not balancing, and suspense account will help you in that. So now let us just assume that maybe there was an error in a trial balance, and we've used the suspense account to correct that error, and now our trial balance has balanced. If our trial balance has balanced, we go to number 4. Let me put the arrows. So after trial balance, now we will create our major 2 financial statements. We will start with the income statement. The income statement is also known as profit or loss account. Okay, so here we will record performance, or some may say profitability. So in an income statement, generally you will record your revenues, and then you will subtract with the expenses for you to get something we call net profit. And we also know that when revenues are less as compared to expenses, if there's a net profit, then we also have a net loss. Okay, so the main objective for you to create an income statement is to see how the company is performing, and you will only know that if your result will be either a net profit or a net loss. So we will see how you create an income statement. And then after that, after you've gotten your net profit, now you will be able to create the final statement, financial statement, which we call statement of financial position. It is commonly known as a balance sheet. Now this one records, let me say, net worth. Statement of financial position records the net worth. So here you normally use the accounting equation, whereby assets is equals to capital plus liabilities. Okay, so if you look at these statements, there is a certain format which is being portrayed. Here you will start with the revenues, and then now you will less the expenses for you to get the net profit. And then now this value for the net profit, you will be required to use this value, whether it's a net profit or a net loss, here under capital. And then now the structure of the statement will be guided by this accounting equation. Okay, so under fundamentals of accounting 1, these are what you need to know before you go to an exam room. Okay, and with these other videos which are coming shortly, they will help you to ace that exam. Before I finish, I would like to emphasize on something. If you look at what I was talking about revenue, expenses, asset, capital, liabilities. So maybe just to help you, because this will be key in us discussing journals. Okay, so this is what we will do. The moment you see these words, revenue, expense, asset, capital, and liabilities, you just write recall. I know some of you already know. R represents revenue, E represents expenses, C represents capital, A represents assets, and L represents liabilities. Okay, so we will use these letters which are alternating to each other because they share a common factor. Okay, so up here we have one family. Okay, we have revenue, capital and liability. And then down here we have expenses and assets. Okay, so why am I talking about this? It's because the moment you have an increase in either revenue, capital, or liability, the moment you have an increase in any of these three, you will credit. The moment you have a decrease in any of these three, revenue, capital, or liability, you will do the opposite, debit. And then these other two are the vice versa of this. So if the expenses and assets will increase, you will debit that amount, and when expenses and assets will decrease, you will credit that account. Okay, yeah, so I believe that one was important for me to talk about, and I hope that everything will be clear in the other videos to come. So see you in the next video.